One other stat that we're actually keeping an eye on this morning as well, energy prices. I mean, that came up within this report as well. That downward trend providing welcome relief for motorists, but how is the highway rest stop coping with energy volatility and rising EV use? For more, we've got John Pertchik, who is the TravelCenters of America CEO. John, great to have you here with us today. Just as we were breaking down some of the data here on consumer sentiment, continued declines in energy prices, where do you also see that playing into your businesses and within the rest stops, perhaps?
Sure. So first, so your viewers know, we're the largest publicly traded travel center company in America. We're in 40 states, and we serve both motorists and 91% of America's largest fleets. Remember the Fortune 500. Volatility for this business, and we're coming off of a huge quarter after 9 previous great quarters. Volatility in general, whether up or down, actually benefits us, and just a matter of a few pennies are very meaningful to our bottom line. So, we're still seeing a lot of activity on the freight side, meaning truckers, trucking, very robust. It's year over year stable for us. And that's coming off of a lapping couple of very strong years. And on the gasoline side, motorists are motoring a little bit less, but we've seen it again this quarter. We saw it most, really crystallize the inherent resilience of this business, where when one area may be a little soft, other areas pick up and lead to the results we just put up a couple of weeks ago in our earnings.
John, when gasoline prices come down, do you earn a better margin on those gas sales?
It's not that simple. No, we don't. It's really more a matter of the differences. And so when there is volatility, the difference between how we purchase and how we sell. And so long as there's movement up or down, we have opportunity. And one other thing just to point out, we tend to sell a lot more diesel than gasoline. So our performance is driven more by truckers trucking than it is consumers, motoring. We sell about 8 gallons of diesel for every gallon of gasoline.
In terms of kind of the cost inputs that you have to think about with your business, where do you need to make the most adjustments at a time like this, if at all, as we've seen a lot of other businesses need to restructure their own costs?
So we undertook a transformation, nothing to do with current conditions, a couple of years ago, and we really reorganized the entire organization. Now, to your question about how we're reacting to the current times, high inflation, potentially recession, we're really focused on ensuring we have a wide range of offerings, and we're famous for that, by the way. Our travel centers are larger, they have more food offerings, and we're making sure we're creating combinations, we're creating special discounts and incentives and other things, as well as just ensuring we have a range of options from lower cost items to others, as well as, again, offering combinations. That's really where our focus lies in the retail part of our business. And again, I think our quarter proved it's been successful so far.
And John, is inflation, I mean, we get that there are signs of it's peaking, but is it still so high that a trucker is opting for our Twinkie for dinner and eating out of their truck instead of going inside to one of your restaurants for a nice sit-down meal?
It's really interesting. To that exact question, truckers really, really care about having a sit-down meal more than, finding, on the cost side. When you think about it, when you're sitting in a truck all day long, you don't have any human real contact. It's maybe, voice sounds over a CB, which, by the way, are still used. So an actual sit-down meal matters a lot. And we're really the only company on the highway that is doubling down and remaining committed to sit-down full-service restaurants. The other companies who we compete against on highway have moved away from that. And that's been a real differentiator for us.
This has been a big year as well for infrastructure spending. Do you imagine that if there are more kind of highway projects to be undertaken in the coming years, that you're going to be ramping up or accelerating the number of locations that you have?
We're both partly because of policy and investing in incenting infrastructure, and separately just fundamentally to undertaking this 2.5-year transformation. We're growing very rapidly. We're very focused on acquisitions, acquiring independent travel centers and moving them into our network, as well as rolling through franchise, which I think we've signed about 49 new franchise locations since 2019. And I expect both of those to continue, separate from just organically improving this efficiency of the underlying business. But yeah, I do. I see a really, really bright future for us these next couple of years.
Will the Inflation Protection Act, will that help you in any way roll out EV charging stations to your locations?
There's a lot going on the government policy side from that, and there's something called NEVI, which is $8 billion of federal money being passed through the states. We're very, very focused on rolling out EV, although I want to make sure we're cautious and careful, as Rob Barnett earlier said, on an earlier one of your earlier guests, this is a multi-decade rollout in terms of complete conversion, particularly on the heavy-duty trucking side. For EV, the grid's not ready for it. There's a lot of things that have to happen over a long time. But in the nearer term, we are very committed and are preparing to roll out EV in places like California, where utilization is going to be high very soon. It's starting already. And in other states where we expect high utilization. And then finally, areas that utilization won't be there, meaning people are not going to be consuming EV vehicles anytime really, really soon in proliferated scaled ways. We're going to be cautious in those areas. But most definitely, I do expect our behaviors to be influenced, and others, our industry, by government policy currently. So yes, we will be rolling out more EV.
Even though that is kind of a years-long process, what kind of, in your forecasting, what kind of net additive do you believe that will give to Travel Centers of America in revenue that you may see, or even margins?
It's really tricky to say because it's not clear, and the government needs to think about this. In different parts of the country, you can't, for example, resell electricity at all. In other parts, you can sell per kilowatt hour. In other areas, you can sell per unit of time. The private sector needs some clarity over, frankly, how it can make even a little bit of margin. That's directly on the re-energizing side. What we do expect, although it's a bit hard to financially forecast, is that dwell times, right? When somebody refuels with gasoline, they may be at our stop for 5 or 7 minutes fueling, maybe inside for a few minutes. On the EV side, you're there for 30 to 45 minutes. And those dwell times, we're focused very carefully on what do we do? What can we give our customers of the future to spend their time and to be more attractive, knowing these dwell times are different. Frankly, often when I travel a lot when I'm in airports, I look around often because you think about dwell times in airports, right? People are there, they have to be there an hour before. They're there about an hour. And plus, by the time you get through security, maybe they're 45 minutes. So there's some things we might be able to learn by how airports offer retail opportunities. And I think over the years, we're going to have opportunities to learn from places like that.
All right, we'll leave it there. John Pertchik, Travel Centers of America CEO. Good to see you. Have a good weekend.